Good afternoon, everybody. Uneducated Economist here. The other day I put out a video talking about credit card debt and how I noticed on usdebtclock.org that there was a dropping in the credit card debt that was out there. And a lot of people said that this was due to the refinancing of homes. People are refinancing their homes with the extra money they're paying off their debts. And that's a totally reasonable argument. I was more under the impression that this had to do with more of debt issuance, like the banks are just simply not issuing out that credit card debt. And I came across this Federal Reserve survey from January of 2019. It's titled Senior Loan Officer Opinion Survey on Bank Lending Practices. Now, I'm not going to read you the whole thing, although it is pretty telling inside of this survey. What I am going to read you is a couple of paragraphs here that I've highlighted. It goes like this. For loans to household, banks reported that their lending standards for most categories of consumer loans and residential real estate loans remained basically unchanged on balance. Credit cards were the one exception, with standards reportedly tightening over the fourth quarter. Meanwhile, banks reported weaker demand for all categories of loans to households. In addition, the survey included a set of special questions inquiring about banks' expectations for lending policies and loan performance over 2019. Banks reported expecting to tighten standards for all categories of business loans as well as credit card loans and jumbo mortgages. Demand for most loan types is expected to weaken on net, with the one exception being credit card loans, for which demand is expected to remain unchanged. Meanwhile, banks anticipate that loan performance will deteriorate for all surveyed categories. So right there, they are saying that in the very end of that sentence right there, meanwhile, banks anticipate that loan performance will deteriorate for all categories. Right, for all surveyed categories. So these guys are worried about their performance of their portfolios coming up through 2019, and they're saying right there that they're going to start tightening up a lot of their standards as far as how they're going to be able to issue these loans out to people. It goes on to say here at the very end, it says, an expected deterioration in collateral values was the most widely cited reason for expecting to tighten standards. In addition, a majority of banks reported that an expected reduction in their risk tolerance and an expected deterioration in the quality of their loan portfolios contributed to the expected tightening of standards. So you guys hear that? These banks are worried. They're worried about the collateral values, right? An expected deterioration in collateral values was the most widely cited reason for expecting to tighten standards. That's when your house goes underwater, okay? Now, they're not saying that right there. They're just saying the collateral value. So when the prices of these homes start dropping, so you take out a loan for $400,000, but now the house isn't worth $400,000, that's what they're talking about. It's worth less than that. And they're talking about that being one of the issues and that they're tightening up their standards, because if they just give these loans to people who are not necessarily credit worthy, they may just default on that if their house isn't worth what they're paying for it. Other people, somebody who's a little bit more credit worthy may not be so worried about paying for a house that's a little underwater, if it's, suits their needs and, is within their means to purchase it. Somebody else who's questionable on whether or not they can do it, they may not get the loan now. And in fact, they're definitely not getting the loan according to these guys. They're saying that their risk tolerance is tightening up. And then, right there in the very end, in addition, the majority of the banks reported that an expectation in the reduction of the risk tolerance and an expected deterioration in the quality of their loan portfolios contributed to the expected tightening of the standards. So, seeing as how credit cards are probably one of the easiest access to credits and probably one of the worst for people who are bad with credit. So, it's no wonder that credit cards are tightening up. They don't want people to just go willy-nilly spending this credit because they're worried about the quality of the loans that are going to be coming from 2019. And this survey pretty much says that. Anyway, I'll leave a link down in the description for you guys. Uneducated Economist, you guys let me know. I'll let you guys take a look at the river for a little bit. You guys have a good afternoon.